End of the pandemic is offering a moment of reckoning for Byju's. Lockdown and online classes had catapulted the Byju Ravindran-owned startup into the world's most valuable edtech firm. But as the pandemic waned and students returned to classes, the ecosystem thriving on online classes started feeling the pressure. Byju's empire too started crumbling. But during its heyday, it took a decision which may help it tide over the current crisis. It acquired coaching giant Aakash Institute. Aakash, which prepares students for NEET and IIT entrance, has over 325 centers and serves more than 4 lakh students. But there was a glitch in the deal. Byju's had acquired Aakash for about $950 million, of which 70% was paid in cash and 30% was meant to be adjusted against equity of Byju's parent company, Think and Learn. But the stock deal got stuck. Promoters of Aakash rejected the equity share and demanded cash settlement instead, after Byju's ran into multiple problems which put its balance sheet under pressure. But now, the two parties have reportedly come to an agreement. Akash Chaudhary, the promoter of Akash Educational Services, is reportedly returning as the CEO of the tutoring unit. It signals that the 2-year-old impasse between the two firms has been resolved. The transaction is expected to be finalized this month. Chaudhary's likely comeback has stoked speculations regarding the kind of potential implications it could have for Byju's and the educational ecosystem at large. Chaudhary family holds about 18% of the Akash's shares. Under the fresh arrangement reported in a business daily, the family will hold around 8.5% in the tutoring unit and receive about 1 to 2% of Think and Learn shares at less than half of its previous $22 billion valuation. Think and Learn will hold around 51% shares of Aakash after the deal. Byju's is also planning an IPO for brick-and-mortar institute Aakash.
Now that the pandemic is gone, there is a world that has limited use or patience for someone like Byju's. People want classrooms, brick and mortar, teachers, interactions in person. In the second version, which is the version now, something like Akash becomes far more valuable, which is the reason why Byju is said to be planning an IPO for Akash, not for entire Byju's. It's trying to raise loans with Akash and its assets as collateral. There seems to be a lot of interest in Akash and a little less in Byju's, which is why I think going forward, Byju's will do well to make the best use of Akash in whatever way it can.
Akash is just one aspect of what Byju's needs to regain its lost glory. If anything, there is a long way to go, and for it to regain its lost glory and its revenues, loss of revenues, etc. I don't think it is just going to be Akash or this deal which is purported. And let us be clear, here even the buyer of the Akash shareholding knows that Byju's is in trouble. So they would ask for an arm and a leg before they sign any deal, before a deal is concluded. So it's not an easy deal to close.
Post-COVID, demand for offline education has picked up pace again. And this ownership exchange highlights the continuing strategic partnership between the two firms that could bring about a remodeling of teaching techniques through a more seamless integration of offline and online education. Experts agree that Byju's needs to refocus on its core offering, that is classroom teaching, and strengthening its alliance with Akash might prove to be a big step in that direction. Now, what exactly does the edtech unicorn's future hold? Only time will tell.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.